Welcome to the InterMarket Analysis video update. This is a weekly video where we look at a number of different things. The first area that I look at goes through growth versus value, because when growth is leading value, that's when the market has a tendency to really rise. When value is outperforming growth, the market really has a tendency to go sideways, if not down. I also look at the valuation of the S&P 500 on a historical basis as well as on a forward-looking basis. We look at other markets, we look at the sectors, and we compare them with the S&P because by keeping an eye on these areas, we can get some clues as to what's happening inside of the S&P 500. This is being prepared for Monday, November 11th. There's a thing called the SPXInvesting Program. I developed the program. It's up, it's going. There are links to take you to the website. There is a link to a video about the program. It's free until the end of 2024. Please feel free to check that out or send me an email if you have any questions. Also, this is just one of the weekly videos that I do. The main foundation of the analysis that I do is based around the daily video, and all of the weekly videos that I do are meant to tie in to the daily videos. All right, let's look at valuation. This looks back at the trailing 12 months, and what you see is a red dashed line, a blue dashed line, and a green dashed line with a PE ratio of 10, 15, or 20. We are well above the red dashed line of a PE ratio of 20, so that means that the market on a historical basis is overvalued. But you can see that we've been overvalued for a long time. Personally, I don't use this as some kind of a timing mechanism. I don't really use this to make decisions. I use this more for information. So we can look at this and go, yeah, historically, the market is expensive right now. I blow it up down below to show you the distance between the current value of the S&P and the PE ratio of 20, just to give that a little bit easier of analysis there. Also, I plot the same thing, but different events that have happened going back to 1980 and what the valuations were at that time. Now, Robert Shiller, who wrote a book called Irrational Exuberance, I'd highly recommend the book. In that book, he came up with the Shiller PE ratio. You might hear this referred to as CAPE, C-A-P-E. You might hear it referred to by other names like PE10, because that tries to take a smoothed approach at looking at earnings and comparing it with price. Well, the current value right now is 38.25, and that is considered to be pretty high when you compare it to the median and the mean between 16 and 17. But we've been that way for a long time. We've been overvalued according to this, and it doesn't really seem to impact the market. We can just look at this and go, yeah, the market's expensive. Well, our earnings are still growing for the most part. There's stocks are hitting all-time highs. And so, yeah, you can say, yeah, the market's overvalued. We're due for a crash. But how long is that going to take? But we just want to keep an eye on this because if things ever do switch over and turn more negative, this will probably come into play. And somebody will say, yeah, look, I told you so. Well, they've been telling us so for many years now. This looks forward, though. This is put out by Edward Yardeni, another site that I would highly recommend, yardeni.com. All of his charts are freely available there. He's an economist. And what he plots here is forward PE ratios. And we have this pink PE ratio. That's the mega cap 8. And those are the high flying stocks, the NVIDIAs, the Googles, the Apples. And they have a really high PE ratio, even looking forward, where it's coming in at 28.5 right now. That's well above that 20 level. We look at the red line. That's what I focus on the most. That's the S&P 500 forward PE ratio. That's even going up too at 22.2. So even looking into the future, we are still considered to be expensive. Now, this past week, the election is finished. The market's hitting all-time highs, doing really well. And we're seeing some strength in the mid caps and small caps. They're more fairly priced right now. And a lot of people are asking, okay, the mid caps were stronger in 2024 and then just kind of started to underperform. The small caps, it looked like a year ago, they were breaking to the upside, then they fell back. And then numerous times throughout 2024, they would break out only to fall back. Is this time different? Now, if they keep going up, the PE ratio is going to go up as well. We're coming in at 16.8 for the mid caps and 16.7 for the small caps. If price goes up, we're going to get closer to that 17, possibly 18 range. So we'll be keeping an eye on this, but not necessarily using it as some kind of a timing tool. We keep an eye on growth versus value. Growth, you want to buy low and sell high. Value, these are stocks that tend to hold up better when the market is more defensive. Folks get into these since they tend to perform well when the economy's not doing as good, when interest rates are going up rather than down, and we compare the two. Well, first, we look at just growth all by itself, which you can see it's really doing well right now. We also look at value, which is doing good. So independently of each other, both of these are in uptrends. Now, you could see more of an uptrend with growth where value has been more or less going sideways, but they're both still positive by themselves. Where we get some insight is when we do ratios between the two. And on the top, we can see where growth is outperforming value, and inverse, because there's slight differences in calculations. This shows how value is underperforming growth. And now we look for confirmation by looking at indexes and ETFs. We break it out into small caps and mid caps and the S&P and see, are we seeing the same thing across the board here? Well, when we look at this index longer term, we're seeing that growth is outperforming value when this ratio is going up. When this ratio is going down with this chart, that means that value is underperforming growth. We look at some ETFs showing how growth is outperforming value. And this, a shorter term chart showing how value is underperforming growth. And then some other indexes, shorter term. Again, we're seeing confirmation that growth is outperforming value. We look at some ETFs, a growth versus value ETF. We were chopping around and showing some weakness there for a while, but now we're starting to see the growth ETF outperforming the value ETF. Then here's an inverse showing how value is underperforming growth when we compare these ETFs. Then small caps, seeing some improvement here. Is this going to change? We're still in a downtrend. You see the red line is above the blue line. The shorter term moving average is below. That means we're in a downtrend, but we're starting to see some improvements along the way here. If this could keep going up, that could be positive for small caps. Also, still in a downtrend when we look at mid-cap growth versus value, but seeing some improvement as well. Is that going to continue? We are positive when we look at S&P growth to value. These are the large caps. These are the stocks that make up the S&P 500. And although they're not really breaking out, they are in an uptrend and they are doing quite well right now. We want to keep an eye on inflation. And first we look at a long-term chart. A CRB is a commodity index. And we just look at this with on a monthly chart with a moving average, and we're pretty much going sideways longer term. So we're not seeing really, according to this, that inflation is a problem. We're not really seeing that deflation is a problem. Then we look at a ratio between inflation and deflation down here. It is coming down, and we like that because we want inflation to come down. The only thing that we're kind of keeping an eye on longer term is if this really keeps going down, 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 then deflation is actually more dangerous than inflation. So we just want to see that is there a balance between the two. Right now, inflation is going down. The market likes that. That helps the economy. And so this is seen as positive. Here's a daily chart of the CRB index where we just got done looking at a monthly chart where we're still in a downtrend, but we're kind of chopping around right now. And we could be getting ready to see a golden cross here, which would mean going from a downtrend to an uptrend, but we're not quite there yet. We also keep an eye on inflation by looking at the Baltic Dry Index. Generally, if this is going up, that's inflationary. If this is going down, that's deflationary. Well, actually, we were going sideways and we dropped a little bit lower, so this is not really suggesting inflation is a problem. Then I have a new chart. There's actually an ETF out there. The symbol is RNIF, and it's actually an ETF of inflation expectations. And so we can chart this. What is the market thinking here? And we were really going down. This is the whole COVID crash where everything went down then. And then as the Fed came in and Congress came in and they lowered interest rates to zero and they sent out stimulus checks and all of that, well, the market was anticipating that being inflationary, and it was. And we saw inflation really starting to pick up. And then into 2022, which was a bear market, for stocks, we we started to top out here, and then we still are going up right now, but we have to look at the context. Are we going up because inflation is a problem and out of control and could hurt the economy? Or is inflation going up because we're seeing growth in the economy? And when you're growing, that can be inflationary in and of itself, but that's healthy when those type of things happen. So right now, the context had been negative when we were going up in 2020, 2021, into 2022. Now it seems to be shifting over where this going up, as long as it doesn't just scream to the upside and no real weird things happen with the economy, this could be taken as positive. Some other markets just to keep an eye on here. Aluminum is still in an uptrend. Corn is in a downtrend. Wheat is chopping around, but still in an overall downtrend. Fertilizer, a big part of that can play into inflation. It doesn't seem to be really acting crazy right now. Oil, we're watching this because of oil companies that make up the stock market, but we're also watching this for geopolitical reasons because of what's going on in the Middle East. Not really spiking up the way we've seen it happen before, but that could change at any time. We look at a gold to oil ratio, and gold has been doing well, just coming off of all-time highs here. Oil has been under a little bit of pressure, and that's why we're seeing this ratio going up, meaning gold is outperforming oil. And then we do a correlation between oil, which is the red dashed line, which has been coming down, and we compare that to the 10-year yield. And they have a real strong tendency to move in the same general direction. And we can see down below that the correlation is not really strong, but they're having a pretty strong tendency right here. They're coming down both at the same time. They're going in the same direction at the same time, either up or down. Gas is still in a downtrend. Heating oil also in a downtrend. Natural gas chopping around and just barely starting to go back into an uptrend. Diesel also, for the most part, this is the spot price. That means cash, what it is right now. Most part, it's coming back up lately. We're seeing some improvement in the transportation index, but if diesel really starts to go up, that could have an impact on the transports. But for most of 2024, we've been going down with diesel, but a little bit more of an uptick lately. Copper, another barometer of the economy. Typically, when copper's doing well, that suggests that the economy is looking good going forward. We are in an uptrend. It's been really choppy lately, but we still have the blue line above the red line. And then we do a copper to gold ratio. When this is going down, that means copper is underperforming. And we look at a longer term look at that same chart. And we're seeing a real disconnect between the 2-year yield and the 10-year yield here and the copper to gold ratio going down, where before they had a tendency to move in the same general direction. But we've been watching this now for about 3 years, and we're seeing this real disconnect between them. Are they going to be able to get back into line with each other? But this is longer term. Gold coming off of recent all-time highs. Silver falling down below its 50-day moving average, but still in an uptrend. Then the closing value for gold on top, the closing value for silver on the bottom. And this just says that the correlation between gold and silver is pretty strong right now. They're both either going up or down together. Then we look at a gold to silver ratio on top, which right now is going up. That means gold is outperforming. And we compare that to the US dollar index. When we're right around this dashed line, that means it's neutral. We're not really getting any insight from this particular chart as we try to analyze precious metals to currencies. The US dollar really been bouncing up, but we use moving averages to determine the trend here. So it's still in a downtrend. The longer we stay above both of these lines, the more we might actually switch over into an uptrend. And the stock market likes a weaker dollar. The conversion is more friendly for their books. The import-export relationship is more friendly. So the dollar going up could put some pressure on stocks, but at the same time, the dollar showing some strength shows that there's confidence and there's just going forward or goodness, as you might say, that is being perceived as far as the US currency is concerned, and that adds its own value. The official stance of the US government is they want a strong dollar. The unofficial stance of the US government is they like a weaker dollar. And this is just showing how we finally were able to break out above this and how the dollar's really been showing some improvement. Then we compare this to the euro, which is the biggest currency in the world after the US dollar. And you can see these are pretty much mirror images of each other. And then we also plot the Japanese yen. Those are the three biggest currencies, the US dollar, the euro, and the Japanese yen, just to get an idea of how they're acting. And then I break them out and we look at the euro to the dollar. Now, the euro's still in an uptrend, but you can see it's really been under a lot of pressure lately and it's coming down. It's a little more advantageous if you want to travel to Europe, you'll get a better exchange rate. And the Japanese yen, which is in an uptrend compared to the dollar after being in a long-term downtrend. But this is also under some weakness as well. Maybe if you want to go to Japan, you'll get a more favorable conversion rate there. And the British pound, if you want to go to England, still in an uptrend compared to the dollar, coming down to its 200-day moving average. So far, it has not broken below that. So the British pound has been pulling back, but still stronger than the dollar for right now as far as a trend. Then we look at some indexes, and I do show this in the daily video. We're not really seeing a disconnect, and this could be taken as more positive. Earlier in the year, if you go back to the summer months, you can see where the S&P was really going up in this red line, which is an equal weighted version of the S&P. Everybody was saying, well, it's just a few stocks that are driving the market higher. And we saw that here, and that was true. When we see them closer to each other, even though they're on different scales, that just means the entire S&P 500 is performing better. We want the big stocks to do well if we're going to go high. Those are growth, and those are the things that really drive the indexes higher. But seeing these lines closer together can also be seen as positive. And we look at a ratio between the equal weight and the S&P 500. When this is going down, that means the equal weight is underperforming. And that's what it was doing for quite a while. We're seeing that slowing down and really getting a little bit more choppy as the rest of the market has been showing an improvement. Then we look at a ratio between stocks and commodities. And when this is going up, that means stocks are outperforming. Here's an inverse confirming that commodities are underperforming stocks. The Nasdaq 100, which just came off of an all-time high, and the S&P 500 just coming off of an all-time high. It had been doing better until we got into about the middle of July, and then it started to underperform, and it's in a downtrend when we compare the Nasdaq 100 to the S&P 500, but it is improving here. If this could come back up and actually see a golden cross with this ratio, that would mean that the Nasdaq 100 is leading the S&P 500, and that usually is when the market really shows more strength. But we've still shown strength anyway with the S&P outperforming the Nasdaq 100. The S&P 100 continues to outperform the S&P 500, and the S&P 100 are the biggest stocks in the S&P 500. The Nasdaq coming off of an all-time high here, and then the S&P coming off of an all-time high. They're both looking good, and it had been falling back since the summer months. Now it's starting to see an improvement. We might see, if things continue to be positive, where the Nasdaq will outperform the S&P. Where right here it shows that it's been underperforming but improving. The Nasdaq 100 continues to underperform the Nasdaq itself. And that just means more stocks are participating in the upward move since both of these are coming off of all-time highs. We look at the mega caps, the really big companies, and compare it with the equal weight. And when this is going sideways, that just means the equal weight stocks are holding their own for right now, and that can be taken as more positive. If this ratio goes up, that will really help the indexes to go higher as well. Small caps showing an improvement here, but still underperforming in the long term when we compare it to the S&P 500. Also, this red line, that's the same ratio we just looked at, where longer term, it's still going down but improving. And then the blue line is the S&P 500. And we look at small caps versus the tech sector. Tech is growth, and we've been really choppy here. We'll have to see what happens with all of this here. We're still in a downtrend overall, but if small caps really finally start to come into their own and really outperform because it's a more favorable interest rate environment and the economy is growing and that really helps promote small caps, we might see the small caps get to the point where they start to outperform the tech sector, which is the biggest growth area of the S&P 500 and the Nasdaq 100. So just if this is going up, that's not necessarily negative, but we really want the big companies, since they have such of an influence on the S&P, we do want them to outperform. The big software companies, after kind of languishing sideways but still in an uptrend, now seem to be breaking out a bit. And the robotics and AI ETF looking a little stronger here when we look at it by itself, but not really outperforming when we compare it to the tech sector. It's coming back down into the rainbow. Mega cap, this is the big names. Looking really solid right now, coming in at an all-time high. The Dow Jones Composite Average, which is the Dow, setting an all-time high. Transports, which finally broke out and set an all-time high. Utilities, which had been stronger earlier, but lately have been showing some weakness. They put those together into the Dow Jones Composite Average, and this is setting an all-time high. And then we look at advanced decline line studies, and I do follow these in the daily video. We're above the moving averages with the NYSE common stock, S&P, mid caps, and small caps. The Wilshire 5000, another broad market measure, setting an all-time high. The total US stock ETF, setting an all-time high. Low volatility stocks, also doing well, setting an all-time high here. When you just look at them alone, yeah, they're in a really solid uptrend. Where we get some insight is when we do a ratio between the low volatility ETF and the S&P, they're underperforming here. There was some doubt and some things were changing around there for a while, but this ratio has now started to go back down. If this goes down, that just means that the S&P is outperforming what are typically the more defensive type stocks. You can see here in 2022, when we were going down with the S&P, the low volatility stocks were outperforming. And that's what folks want to do when the market's under pressure. When this is going down, that means the market is going up. Traditional Dow theory. And this goes back, and you have some folks that really rely heavily on this. I look at it. Now, I add another element to traditional Dow theory where I also look at the utilities because those three, the Dow, the transports, and the utilities make up the composite average. But we're coming off of an all-time high here with the Dow. And the transports finally starting to break out. Are we going to see things more favorable? That could really show economic growth, and that could help the markets go higher, where for a lot of 2024, they were going sideways. Utilities had been just roaring to the upside, pulling back, but coming up a little bit since the election. And some of this could be more defensive because folks were concerned about what was going to be happening. But you could also make a case that, especially with electric vehicles and all the crypto mining that goes on and the changes over trying to take on the green agenda and all of that, that just is going to put more of a, especially for electricity, a real demand there. So is it growth? Is it defensive? Now, traditionally, it's been defensive, and we were getting a little bit concerned here, but the Dow was still going up. The S&P was still going up at that time. But for right now, utilities aren't doing as strong as they were, or they're not holding up as well as they were previously. The transports finally coming back and surpassing the all-time high set in late 2021. So that had been another frustrating area. It had been kind of chopping higher. Not so much higher highs here. There's a few of them, but really what we're seeing are lower lows. And finally, with the election finally being completed, we were able to break out to the upside. Can we hold on to those gains? And we look at a ratio between the transports and the Dow, underperforming when this ratio is going down, going sideways now, possibly seeing an improvement here, although we did fall back in Friday's session. And then we look at a ratio between the Dow and the transports. When this is going up, the Dow is outperforming. Are we seeing a change here with this ratio actually going down? And we look at the relationship between the S&P and the transports. Pretty strong right now. So they're having a tendency to go in the same direction at the same time. And now, looking at a new take on Dow theory, instead of using the Dow, why don't we use the S&P, all-time high? Instead of using the transports, use the NASDAQ, since this is more tech, all-time high. And then breaking that down a little bit more, let's look at the equal weight S&P 500, all-time high. And then an equal weight version of the QQQs, which is the NASDAQ 100, all-time high. So we're seeing confirmation there. The FANG index, not an all-time high on Friday, but did set a new all-time high on Thursday. And this is Facebook, Apple, Amazon, Netflix, Google, Nvidia's in there, and you could probably spell a different word now. I just know it as the FANG index. And we're watching this too because there's a couple of trend lines. When we were coming down here, we were actually finding support. Even though we broke below it earlier, we did find support at the lower end of this trend line. Now that we're going back up, we have not broken out above the shorter term trend line, at least yet. If we could break out above this, that would end up being positive for the FANG index. ARC finally has shifted over to an uptrend, even though it's been going sideways, and it's been a real area of disappointment for all the people that got in right at the end of 2020 and into 2021 when it was hitting all-time highs. And Kathy Wood was the rock star of the stock market world, and people were putting all their money into this. And then, I mean, it still has a long ways to go, but at least it's looking a little bit more positive and shifting over to an uptrend. You take the all world stocks, which takes out US stocks, and by themselves, we've been falling underneath the 50-day moving average. Now we're seeing a little bit of an improvement, but a little bit of resistance. We're just under the 50-day moving average that could be providing overhead resistance there. But when we look at the US stocks and compare them with world stocks, the US stocks are just massively outperforming. Then here is a monthly chart of a ratio between US stocks and world stocks that are in Europe, Australia, Asia, and the Far East. Clearly, US stocks are outperforming above an advancing moving average, and the momentum oscillator is going up as well. Keep an eye on bonds because there's a close interplay between stocks and bonds. And we've been really coming down with bonds based on price. That means interest rates were going up, and that was causing some concerns. We're finally seeing here over the last few days that bond prices are starting to go back up, even though they're still in a longer term uptrend. But as measured by the MACD, we're actually starting to cross over positive with the momentum. We're seeing a little bit of an improvement here with the RSI, but we're still below 50. Total bond ETF dropped below its 50-day moving average, didn't quite get down to the 200 at least yet, and showing some improvement here, but still in a longer term uptrend. The Pring World Bond Index, really choppy, but still in an uptrend after it had been falling back. Maybe it's starting to improve now that the election is done. But longer term, and we see this on the daily chart that you see here, where bonds are underperforming stocks. We see it on a weekly chart that I go over in the weekly video. And then right here, the next one, we show it on a monthly chart. But bonds based on price are still underperforming. And this is showing that same thing, showing how stocks are outperforming on the monthly chart. High yield bonds, junk bonds, coming off of setting all-time highs. Corporate bonds, more investment grade, more conservative, had been really falling back, still in an uptrend, possibly starting to improve. And then there's really not a strong correlation between stocks and bonds right now. When we're in this blue to the top and red to the bottom area, that means the correlation is more neutral right now. The corporate bonds, a lot of people get into those, still in a longer term uptrend. They had seen some weakness, could be showing some signs of improvement. And then I have a couple of Fibonacci studies on here, but we're far away from these retracement levels, so I just show these. We could be shifting to a higher interest rate environment, which is not necessarily negative. It could mean economic growth, but if interest rates really continue to go up, and inflation starts to come back, which so far it's under control, but that could always change, then that would change the whole context. But interest rates can go up and stocks can go up at the same time if it's because of growth, because companies are expanding and being able to hire better people and pay them more money. But eventually you have too much of a good thing, and then it goes from growth to inflationary. And here's some other fib retracement lines here, but we're not really close when we look at the 30-year yield. And we look, and I spread this out to try to make it a little longer. We look at stocks versus the 10-year yield. This is when we were in problem territory here with stocks underperforming the rise in interest rates. Now we're starting to see the S&P outperforming. It did see some weakness, almost came down to the 200-day moving average, but has been bouncing back up. If this could continue to go up, that just means stocks are outperforming interest rates. Junk bonds coming off of an all-time high, and they're back to outperforming when we do a ratio between junk bonds and more conservative government bonds, and we've seen a recent golden cross here. Looking at the daily chart of yields where they had been really coming down, then they were starting to go up. We're not sure. I mean, we've seen interest rates coming down a little bit this past week. Are they going to start to trend down, or are they going to turn and start to go back up? Weekly chart. The overall trend here is in the US, UK, Germany, and even in Japan that interest rates have been trending higher. Then we look at the volatility of bonds as measured by the MOVE index. And when bonds were really going down, volatility was going up. And that's what we see with stocks. That's the VIX down here, where the VIX had been very high. Well, then the election happened, the market liked that, and we're seeing a real drop off in the volatility of bonds and stocks. And there's a pretty strong correlation between them right now. And we look at a ratio between the S&P 500 and 1 to 3 year bonds, showing how stocks are just continuing to outperform. We look at a broad market measure, looking at 3 to 7 year bonds, showing how stocks are outperforming. We look at another broad market measure with shorter term bonds. So we have short and then further out, showing how stocks continue to outperform. The tech sector is outperforming the 3 to 7 year bonds. The riskier bonds are outperforming the more conservative bonds. And these riskier bonds are junk bonds. And folks get into that. They're willing to take on the risk because they're not seeing a lot of economic risk and they like the more attractive yield. So they're willing to do that right now. This shows how bonds are underperforming stocks. It's kind of just the inverse of a previous chart that I showed. Then this is a longer term look at the price of the 30-year ETF, where it's starting to come back down a little bit, but the moving average is still going up. We had been declining, and then bonds were looking a lot better, and we started to cross above the moving average, but this is a monthly chart, so it's going to take a while for any improvement to really show up. So we're seeing some improvement, but we were also seeing some weakness at the same time. We look at a ratio between the long-term price of the bonds and the CRB commodities, and it shows how the long-term price is outperforming commodities. Now we look at different sectors, and what I do is there are 11 sectors that make up the S&P. First, we look at just the chart of the sector itself, and then we do a ratio between how's that sector look compared to the S&P 500. We're coming back down to the moving average, but still in an uptrend when we look at materials. But when we compare it to the S&P, materials are underperforming. Communication in a solid uptrend, just coming off of an all-time high. And this is one of the stronger areas. This is a growth area. We want this to be doing a lot better. When we compare it to the S&P, that really helps stocks to perform and the indexes to perform better too. Energy, which came down and we're just getting close to seeing a death cross here with the trend, but it is bouncing back up right now. But when we compare it to the S&P, really underperforming. Where in 2022, energy was outperforming. Now in 2024, it's been underperforming. The financials coming off of recent all-time highs, still looking pretty solid. Also looking pretty good here when we compare it to the S&P. Industrials bounced off of their 50-day moving average, looking a little better. These are more economically cyclical type things. When the economy's doing better, industrials do better. And looking better here, coming with the recent golden cross when we compare it to the S&P. So they're holding up quite well in that regard. Technology, probably the biggest area, the most popular area, what people really focus on, just coming off of an all-time high. But even though we're in a downtrend here and we were underperforming, we were outperforming when we go back to the summer, and then we started to lag behind. Are we going to see an improvement here where the tech sector is actually outperforming the S&P? Now, the stock market can still be positive even if the techs are lagging, but when it really kicks into gear is when the tech sector is outperforming. Staple sector, toilet paper, toothpaste, still in an uptrend by themselves, even though they've fallen under their 50-day moving average. But when we compare it to the S&P, underperforming and just seeing now a death cross with this ratio. Real estate, they don't like interest rates going up, and that's why we were seeing some weakness here, but still in an uptrend. And still in an uptrend when we do a ratio. They like when the interest rates are coming down. They kind of freak out when the interest rates start going back up. We'll see if that will improve. Utilities, which have been really strong, still in an uptrend, coming back up to their 50-day moving average and outperforming and still in an uptrend compared to the S&P, but pulling back recently. And then we do an S&P to utilities ratio. When this is going up, that means the S&P is outperforming utilities. When this is going down, that means utilities are outperforming. We're seeing a little bit of a shift here. So we'll have to see, is the shift going to go back over to the S&P, or is it going to turn back down and go back over in favor of the utilities? Then we look at healthcare, defensive area, bounced off of its 200-day moving average. That's positive. But when you compare it to the S&P, underperforming. Discretionary, really seeing an improvement here. This is Tesla. This is Amazon.com coming back and really looking solid right now. And just seeing a recent golden cross when we compare it to the S&P, where for most of 2024, it had been a real disappointing area and had really been underperforming. Semiconductors, okay, coming down, actually dropping below their 200-day moving average, in danger of a death cross here, but so far bouncing back up. If these can really catch fire and go up, that will help the tech sector. And then a ratio between energy to tech showing how energy is out underperforming, and growth stocks versus bonds. Growth stocks are clearly outperforming here. And the tech sector, compared with the 10-year yield, we came down, bounced off the 200-day moving average with this ratio, showing some improvement. Longer term tech is still outperforming with the trend. And this confirms that. We came right up here to the 200-day moving average, or coming down, still in a longer term downtrend when we look at the 10-year yield versus the tech sector and do a ratio. Discretionary, starting to outperform staples. That's more positive. We're seeing strength in some of these areas, and that's more encouraging. Staples are underperforming discretionary here. Gold and the S&P, not really any kind of an edge. Gold's been breaking out to all-time highs, but so is the S&P. So we're not really seeing any real advantage right now. And gold has been doing well. The dollar had been weaker. It's coming down a little bit now as we've been seeing a bit of a bounce with the dollar. This is what I use as kind of another economic gauge. High leverage loans, risky loans, high leverage means if things fall apart, these are going to fall apart first, setting all-time highs here. And so this is more encouraging. The NYSE composite setting all-time highs in a solid uptrend. All stocks, US and international stocks, recently setting all-time highs. Emerging markets are in an uptrend, still coming back down to their 50-day moving average. The Japanese Nikkei just off of recent all-time highs. Micro caps in an uptrend and looking stronger. These are smaller than small caps. And then I added a line here. We're keeping an eye on this. We look at the S&P and the home builders. Home builders don't like a rising interest rate environment. It's very interest rate sensitive. And they've been doing quite well by themselves, but you can see they're starting to deviate from each other. Where the S&P is going up, the home builders ETF, it's not falling apart, but it's not really going up with the S&P. And we're picking that up here in this chart. If we come down here to a really strong negative correlation, then something might happen here. That sometimes that could be a positive thing. Sometimes it just means a pause before we get ready to go higher. But we want to keep an eye on this one. Bitcoin setting an all-time high, now back in an uptrend. So we're still in an overall downtrend in China. The big spike up was after the Chinese government announced a lot of stimulus plans and cutting interest rates. So a lot of money just went flying into China, and then it came flying back out. Emerging markets are still in a downtrend according to this. Now, this is the KST, which is a longer term, more stubborn oscillator. We're trying to turn back up here in Europe, still going down in Japan, and trying to turn up, but still pretty much declining with the S&P. We're going to have to see more follow through for this to turn and look more positive. On the daily videos, I show this as a long-term oscillator, and they move slow. And we're looking at an InterMarket Analysis chart. Even with some recent weakness, gold is still best year to date, followed by stocks, and then oil, and then the dollar. Bonds are still negative year to date based on price. And we look at some correlations, and you can see right here, S&P going up, dollar going up, strong correlation right now. Typically, we see them going in opposite directions because dollar strength could actually be negative for stocks. But right now, it's like party time. And then we look at the correlation between the S&P and oil, kind of neutral, slight tendency to go in the same direction. And then the S&P to the 10-year yield also pretty much neutral right now as we're you're seeing the stock market shifting and the bond market and a lot of commodities markets because they're relieved that the election is over and now we know who won and it looks like the Republicans are going to be in the executive and both houses of Congress or both chambers of Congress. And so now they can react to that, where it had been more uncertainty what the market was dealing with. But there's still a lot of variables. We have the war between Russia, Ukraine, we have things going on in the Middle East. And so this can change, but we're also in a period of positive seasonality. And we look at the tech sector and compare it with the 10-year yield, also pretty much neutral right now. And then the S&P to the 2-year yield, slight tendency to go in the same direction, which could be positive. You can have the S&P going up and short-term yields going up as well because that means growth. But if the 2-year yield just screams up, that could end up putting pressure under the in the S&P. So we just want to maintain the balance. That's why I look at these charts. Then some long-term monthly chart of the S&P, or excuse me, the NYSE setting all-time highs here, and the trend is still up as measured by the Koppik curve. This is a daily chart of the NYSE, still looking pretty solid. A monthly chart of the S&P, all-time high, and the PPO, a percentage price oscillator, also positive. And then looking really positive here with a daily chart of the S&P and then the ratio between stocks and commodities here, showing how stocks are outperforming. And then a monthly chart, another global one, showing how US stocks are outperforming. Seeing a little bit of a tick up here, but it's pretty much flat with the KST. Then at the very end, I list all the things that are positive. And my definition of positive is when the 50-day moving average is above the 200-day moving average. And we've got a long list here. We have growth and value when you look at them by themselves. Copper, the British pound, the euro against the US dollar, even though the dollar's been seeing some recent strength. The Japanese yen also seeing some weakness, but still in an uptrend compared to the dollar. Gold and silver are in uptrends. The big software companies, mega caps, the FANG index, which is coming off of an all-time high. And the new addition back on here again is ARK, the low volatility ETF. When you look at it alone, but then when you compare it to the S&P, it's really underperforming. Staples, another defensive area, but in an uptrend by itself. The Dow Jones Composite Average, all of the bonds based on price, whether they're government bonds, corporate bonds, or junk bonds. The tech sector and semiconductors, getting kind of close there with the semiconductors. If we see some more strength there, that could really help the market. High leverage loans. I use that as kind of another barometer of the economy, similar to how we watch copper. The Dow, the NYSE Composite and Wilshire, some broad market measures. Those are in uptrend, setting all-time highs. The NASDAQ and NASDAQ 100, mid caps, small caps, and the micro caps. All stocks, both US and world stocks, emerging markets. And then Bitcoin is back on the positive side now. A pretty short list on the negative side. That's when the 50-day moving average is below the 200. Here, where we have the CRB index, which is kind of chopping sideways right now, and the dollar, even though it's been seeing some recent strength, it takes longer for the moving averages to actually cross. Thank you. I hope you found this helpful. I hope you're having a great weekend, and I will talk to you in the next video.